Right now, the public is entirely obsessed with AI chatbots. Everyone is racing to figure out which software will win the artificial intelligence race. But historically speaking, the companies creating consumer software are rarely the ones that generate the most reliable, long-term financial returns during a technological build-out. We can look at the 1849 gold rush for a perfect example. While thousands of miners went completely broke looking for the ultimate prize, the merchants selling the equipment, the pickaxes and shovels, generated massive, reliable wealth. Today, the exact same dynamic is playing out. The physical hardware, the massive power grids, and the advanced chips required to make artificial intelligence function make up what we call AI infrastructure. Investing in this physical foundation is a winner-agnostic strategy. The companies supplying the tools turn a profit regardless of which software application ultimately dominates the market. Training a cutting-edge AI model today requires hundreds of thousands of specialized graphics processors, compared to just a few thousand a couple of years ago. The physical demand for computing power is growing exponentially. To meet that demand, technology giants are deploying hundreds of billions of dollars in capital expenditure, or CapEx. They are purchasing advanced hardware and building enormous new facilities at record speeds. This puts you, the investor, in a tough spot. You likely feel the pressure of missing out on the biggest tech boom of the decade, but you also know that buying into peak stock valuations risks repeating the dot-com bubble. If you just buy random stocks with AI in the headline, you usually end up with a portfolio heavily weighted toward pure hardware companies, exposing yourself to massive, sudden swings in the market. To avoid that kind of whiplash, we have to stop treating AI as a single, uniform category. Instead, we need to break the infrastructure down into specific layers and map them to your personal risk tolerance. This quadrant chart maps our options. Up in the top right quadrant, we have Layer 1, the pure-play semiconductor companies creating the essential processors for artificial intelligence. These companies manufacture the physical graphics processing units, or GPUs, that act as the raw engines for all AI training and deployment. Market leaders like Nvidia and AMD control this space. Because their hardware is the absolute gold standard, their valuations have exploded directly alongside the demand for AI computing. The trade-off here is steep. You get maximum undiluted exposure to AI growth, but you also take on intense vulnerability. Emerging competition or even a slight dip in global hardware orders can trigger sudden market corrections. Layer 1 is built strictly for the growth chaser, an investor who is perfectly willing to pay premium stock prices and ride out extreme volatility for the chance at massive, outsized returns. Moving down to the middle of the chart, we find Layer 2, the hyperscalers and the massive data centers housing all those servers. Instead of selling chips, these businesses rent out AI computing power. This creates an AI as a service model, turning hardware into a reliable, recurring revenue stream. The major players here are Amazon AWS, Microsoft Azure, and Google Cloud. What makes them unique is that their highly speculative AI investments are insulated by extremely profitable, trillion-dollar legacy software businesses. But the risk is real. These companies carry multi-billion-dollar CapEx burdens to build these facilities. If global demand for AI software softens, these massive data centers quickly turn into very expensive, underutilized liabilities. Layer 2 works best for the strategic allocator. It offers a balanced way to capture AI upside without the whiplash of pure hardware stocks. Finally, down in the bottom left, we have Layer 3. These are the secondary infrastructure plays required to keep those massive data centers from failing. First is the networking hardware sector. Moving petabytes of data requires highly specialized equipment to allow servers to communicate at extreme speeds. Second is the thermal challenge. AI processing generates severe heat, which has created a surging, highly lucrative market for specialized commercial cooling technologies. Third is electricity. AI consumes vast amounts of power, turning nuclear generation, renewable energy, and grid modernization companies into highly effective backdoor AI investments. Layer 3 is for the yield and stability seeker. You cap your extreme upside, but in return, you get value-priced, often dividend-paying stocks with predictable, utility-like returns. The AI stack offers clear opportunities, but we have to ground this in a historical reality check, the internet and telecom build-out of the 1990s. This bar chart compares the capital expenditure of the 90s telecom boom against current projections for AI spending. Back then, companies spent aggressively to lay the internet's physical backbone, assuming consumer demand would rise uninterrupted. The internet obviously succeeded and lived up to its promise. But many of the specific companies that overbuilt that physical infrastructure went bankrupt or suffered a lost decade of stock value. The current stock prices for today's leading AI hardware firms are pricing in years of absolutely flawless execution. If supply chains stall or adoption slows by even a fraction, there is zero room for error in those valuations. When you buy into a hype cycle, even purchasing stock in a genuinely great company at the absolute peak of its valuation can still result in a terrible investment. This decision tree flowchart outlines how to navigate the space. AI infrastructure is a complex supply chain, and success comes down to aligning your money with your specific goals. If you want maximum growth, Path A leads to Layer 1 pure play chips. Just be prepared for the active monitoring and volatility that comes with it. If you want a balanced approach, Path B points to Layer 2 cloud providers, mixing aggressive AI expansion with the safety net of existing software empires. And if you want to avoid the roller coaster entirely, Path C targets Layer 3 utilities, trading overnight riches for long-term stability and dividends. Buying the picks and shovels is still the smartest way to play a technological transition, but that strategy only works if you know exactly which tools you are holding and exactly how much you paid for them.